Hello, friends. Welcome back to Market Shares. I'm your host, Tony Blodgett, and here we are wrapping up the third week of 2024. Hopefully, all of those holiday, mood and all that is behind you, and you've settled in to the excitement that is 2024. And I do have to say, I am excited. I'm going to talk about an article that came out here just today, actually, or came out this week, actually, regarding the housing market. And we're going to talk about a few other things. But first, I want to acknowledge that many of us had the day off on Monday. And, although it's always great to have a day off, I think it's important that we recognize why we had the day off on Monday, which was to celebrate both the life and legacy of Dr. Martin Luther King Jr., who I have to say is probably one of the most important figures in history as it relates to really promoting not just civil rights, but, the dream that everyone is created equally and should be treated equally. And that is a foundational belief in the United States. It should be for every single person and every single leader and every single, everyone, in the world, frankly. But I just wanted to recognize that. And as I thought there on Monday, I did take some time and, reflect on why it is we had the day off. I got to say, I didn't always do that. There wasn't always I was like, hey, great, another 3-day weekend. But I think it is important for us. There's a reason why we have everything shut down, on a day like that. And it's incumbent on us to take some of that time as a reflection. And I hope that you had the opportunity to do that. And let's, as a nation, try to remember the dream that Dr. Martin Luther King had and embody that in each one of us. So you guys, a couple articles. I'm going to just make this a quick episode today, but a few things that I thought were very timely and things that maybe you might want to research a little bit on your own. The first one was an article that was in Yahoo Finance. And, we talked about this happening. The headline was "Bidding Wars Erupt as 2024 Kicks Off with Some Listings Receiving Over 30 Offers." You guys, we said this was most likely going to happen as we started seeing interest rates improve as we wrapped up the year. It definitely brought some buyers back to the market. Now, I think we're going to kind of, undulate with rates a little bit this week. We kicked off the beginning of the week with rates, popping up just a little bit with some more comments from Fed governors, sounding a little more hawkish than our friend Jerome Powell did last month. So look, that's expected. This move lower in interest rates is not going to be a straight line. There's no question about that. But what we are already seeing evidence of is the fact that as rates improve, this is evidence that we're going to see a lot of housing demand with not a lot of supply out there. And that's just not a fun experience for anyone looking to purchase a home. It's just not. So I thought that was an interesting article I wanted to point out. I'm not going to be surprised to see some of these, cash buyer programs. Most of them are gone completely. I feel very fortunate that at New American Funding, we do have a very cool cash program. And I know some other companies out there do as well, but I wouldn't be surprised to see, some of those programs work their way back into the market because you're going to need an advantage to win if we get back to this hyper bidding war situation that we saw a couple of years ago. And it looks to me like that may be happening as we kick off 2024. The other thing I want to point out is our friends over at the ReSource did an awesome episode this week. It came out on Monday. You should go back and watch it. If you remember Ryan Hills, that's his podcast that he puts out every single Monday on the ReSource. And they talked about what do interest rates typically do during an inflation year, or excuse me, during an inflation. We know what they do in an inflation year, they go up, but what do they do during an election year? And we are into an election year. We just had some election stuff going on here. Monday of this week, we got Super Tuesday coming up. We got all sorts of things going on to kind of kick off this election year. Woohoo. I don't know about you, but I I'm not excited about being in an election year. It's almost like you just want to turn off your TV for the year and not pay attention because it's going to be ugly out there. But nonetheless, this was a very interesting episode that they did because I think there's a lot of people that say, oh, it's an election year, the market's going to do great, or interest rates are going to get better because it's an election year. And they kind of tie this to the fact that it's an election year, like that has some sort of a direct impact on interest rates. So go back and watch their episode. They really unpack it. They go through all the elections back to the 70s, whether it was a Democrat to a Democrat incumbent or vice versa. They went through all the different scenarios. And I think what you're going to find is interesting. I will tell you that I believe that the market and what happens with inflation, like that Freudian slip I just had a minute ago, what happens with inflation, what happens with the economy, do we get a soft landing? How does the Fed do their cutting of interest rates? Do they do the 3 that they're predicting? Do they do the 7 that the market's predicting? Do they do somewhere in between? My guess is those will have a bigger impact, but do go back and watch their episode as they go deep into, it's about a 26-minute episode if I remember correctly. So lots of details. And I think honestly, if you're going to be advising your clients, or if you're going to have, you might even have clients say, well, it's an election year, so, I'm going to wait, or it's an election year, so this or that, be armed with that information to help you guide and really bring truth to your clients that you might be working with. So anyways, interesting article. Great job to Ryan Hills and his team over there. They killed it. The other article that I want to mention, and this is really the main topic I want to discuss, it was an article that was in National Mortgage News. Now, this is not news to me. I've been hearing about a lot of these things for a while. But what the headline of the article was, in case you want to go find it, was Capital Rules May Radically Shift the Mortgage Industry. Capital rules may radically shift the mortgage industry. And you guys, this is no joke. I think we're going to see a lot of changes that have been kind of brewing for some time regarding capital requirements. And this may be for servicers as well. I'm going to talk a little bit about that. But what we're seeing, and this isn't specifically addressed in this article, but I think it's something that's important to mention, is that all mortgage companies have requirements, right? They have covenants that they have to abide by. And in a year like 2023, when almost every mortgage company out there is losing money, almost every mortgage company out there is in one way or another more than likely in breach of one, if not many, of their covenants that they have with their counterparties. And during a year like that, it's like when everybody is in the same boat, what you find is that your warehouse lenders, your correspondent relationships, they tend to give you what I would call a holiday on meeting your covenants. And it's not because it's not because they want to do that, but when they recognize that all of the people they do business with are dealing with the same similar situations, we still have to provide liquidity. We still have to provide the necessary means for companies to operate. So they don't just shut everybody off and provide no warehouse lending or buying any, loans on the secondary market. And so what they do is they tend to be a little bit relaxed in how it is that they enforce those covenants. They give people, a pass, if you will, when they're out of line. But what I hear coming back online as we move into 2024 is kind of a retightening of those requirements. Look, they're going to be requiring that mortgage companies be within the net worth requirements, be within, their profitability requirements. Maybe this results in some renegotiation of those covenants, but nonetheless, there's going to be some tightening of that. And I think there's mortgage companies that are, right on that brink. And I've been there before. At my previous company, we had periods of time where we were very close to, those covenants, if not breaching those covenants, and we had to work through it. And it's a stressful place to be. And I think what you're going to see as a result of some of this pressure is some of these mortgage companies that, they made it through 2023, but not by a lot. And as you see things starting to tighten back up, and although we do foresee interest rates improving as we move into 2024, I don't think anyone is predicting a crazy year as far as production goes. That's just not likely. Even if we had a massive drop in interest rates, there's just not that many loans originated in the last couple of years since rates went up that we can even refinance. And so it's not expected for this to be a barn burner of a year and just turn things around. I think it's going to be a better year than 2023, but it's going to be a build over time. And I think what you're going to find is there's going to be some mortgage companies that are just tired of giving back all that they made in the unicorn years of 2020 and 2021. And they fought a good fight, and now the pressure is going to be on. Everyone has to obviously wrap up year-end financials. So by the end of the first quarter, don't be surprised if you see a lot more mergers, acquisitions, consolidations, maybe even closures of certain mortgage companies as we move into this season. I think that's a likely thing that we're going to see here in 2024. And I think we're already starting to see some of it out there from what I'm hearing on the street. So a couple things that are going to be coming regarding capital requirements. So we all know about Basel III. Maybe you don't know about Basel III, but this has been in the works for a long time and is kind of a rewriting of the rules as it relates to capital requirements for banks. Now, there's also new capital requirements that are going to be put in place by the enterprises, Fanny and Freddie, as well as Ginnie Mae rolling out some pretty significant changes to what's required if you're a servicer of government loans, Ginnie Mae loans in particular, and what your capital requirements are. So I think you're going to see those rules get finalized as we kind of roll in through 2024. And I think all of this, as the article pointed out, are going to have an impact on mortgage companies. The other thing that I think these rules could have as a consequence is how it is that they provide warehouse line funding. So what that is, just to give you a quick story, is mortgage banks, non-bank mortgage companies, and even some, bank mortgage companies will use the funds from other banks in order to provide interim financing, or what we call warehouse lines, to fund loans prior to them being sold on the secondary market. So as a quick example, if I were funding a loan for you, and let's say it was $300,000 loan, we would borrow that money from our warehouse lender. We would fund that loan. We would turn around a few days later. We would sell that loan, and then we would pay back the loan that we borrowed from our warehouse line. Well, if you can imagine a large mortgage company that is funding millions and millions, tens of millions, sometimes hundreds of millions of dollars of loans in a given month, that's a lot of money that could be out at any given time. Even though it's usually held for a very short period of time, this can be a massive amount of outstanding debt. And if you think about these capital requirements as they relate to the warehouse lenders themselves and having all this money deployed, they're going to have to meet certain capital requirements as a warehouse lender. And so going back to my earlier statement of kind of tightening up a little bit on companies meeting these covenants and so on and so forth, I think this could even layer more pressure on those warehouse lenders to run a tight ship as it relates to how it is they're providing warehouse line liquidity to non-bank mortgage companies because of the restraints that they might be under. So now we have the pressure, if you're a mortgage company, of meeting those requirements, but then you also have the pressure that's put upon the warehouse bank companies, which is going to make them kind of tighten up their rules potentially even more. So I think we go from this very loose environment that we saw in 2023, because everybody was kind of in breach, to them trying to shore that up while also having to meet some of their regulatory requirements regarding capital. So all of that to me points towards a very, I don't want to say difficult, but a change to the stance, if you will, of of what you can expect if you're using a lot of warehouse capacity, and if you're, close on your margins and covenants. I wouldn't be surprised to see some warehouse lenders just pull back and really focus on a smaller group of companies that are, very well capitalized, in order for them to meet some of those requirements and remove some of their risks. You might also see that as a result of this, some mortgage companies might retain less of their servicing, or you might see companies that, before were selling to aggregators. So when I say aggregators, think about this. A lot of mortgage companies sell their loans to the same companies, right? You got a handful of large companies out there that are purchasing mortgage loans. It's also, where a lot of mortgage brokers, when they originate a loan, they don't work for a mortgage banker. They're originating it directly with another mortgage company, which many of those would be these large aggregators. And so what you might see is these aggregators, as a result of needing to meet certain capital requirements themselves, you might see a little shift in how it is they're pricing their loans. They might price themselves out of the market a little bit. And so you might see mortgage companies deciding to sell their loans directly to Fannie and Freddie, direct to the agencies, not doing as much with the aggregators. And so that might provide a shift. Matter of fact, what I would think that might do is it could potentially mean a little bit less pressure on interest rates, with the secondary market not being so aggressive, because maybe they don't want all of those loans because of these capital requirements. And I think the party that would be hurt the most by that would be loans that are originated through the TPO channel. So these are third-party originated loans, loans that are done by a broker or a mortgage banking company that is originating these loans as a TPO, and using their wholesale kind of a structure. So interesting to see what happens there, if there is any shift in more companies selling direct to the agencies, maybe less activity with aggregators, and what does that mean for interest rates for lenders that predominantly send loans through the TPO or wholesale side of the business. Also, intersecting with some of these rules, as I mentioned, Ginnie Mae. So you have these, Basel III, you have these other capital requirements that are coming. But in addition to that, Ginnie Mae specifically has introduced some risk-based pricing, risk-based servicing requirements, and that's going to more directly impact lower down payment, potentially higher risk loans, right? Loans that are typically geared towards first-time home buyers. And so as a result, you may see certain companies, certain entities do less of that business or shy away from that business. We've already seen, all the big banks essentially have completely moved away from providing, FHA, VA, USDA loans. These are all loans that, would be securitized into Ginnie Mae securities. And we've seen a big pullback on that. A lot of that was due to, lawsuits and misrepresentation of underwriting guidelines, or, misappropriating underwriting guidelines, and lawsuits from HUD and so on and so forth. And so you saw the big banks pull away from that. But now you might see, because of the capital requirements that are imposed by Ginnie Mae, you may see less of that available. Again, potentially leading to less demand for those loans, potentially higher interest rates, which is really what we don't need. First-time homebuyer programs, being less favorable with less people offering them. That's definitely not the direction we want to see things go. But that may be one of the implications of some of these rules. And and one of the things to remember about Ginnie Mae loans, not only do we have Ginnie Mae putting in additional capital requirements based on risk, Ginnie Mae loans are also done on a actual scheduled remittance, which means that regardless of what the borrower pays you, you still have to remit your the scheduled payment to Ginnie Mae on that security. Now, most most companies have arrangements with Fanny and Freddie that if the borrower doesn't pay, then you don't have to pay. You're not paying on the borrower's behalf if they don't make their mortgage payment. Now, this will ultimately lead to, potentially a foreclosure or whatever ends up happening with that loan. But on Ginnie Mae loans, the mortgage company is required to continue to make those payments, even if the borrower has stopped making payments, which is, as you can imagine, why they might put higher risk retention and capital requirements on those loans. But that alone will keep certain mortgage companies from wanting to dabble in that space. So this article was very interesting. If you kind of nerd out on this stuff like I do, I highly suggest you go to National Mortgage News and look for the article about capital rules, because this is the time where a lot of mortgage companies have been through a very difficult season. The last 18 months has been very challenging. And so they may be low on cash, and this is not the time to come in and put these additional rules in place. And I definitely believe that to the article's headline, this could cause a little bit of a shake-up or a shift in the mortgage industry. So you guys check out those articles. I think they were very interesting, and we'll continue as we move on through 2024 to try to, shake up our content, give you some headline stuff, what's going on in the news today that I thought was interesting. And we got some really great interviews coming up as well. So please continue to tune in to Market Shares. And as I ask every single week, please let someone in the industry know about this, because they might enjoy it. They might like to check it out as well. So share it with a friend, like and subscribe to our channel. And you guys, I look forward to seeing you next week. Take care.